Hello, everyone. My guest today is Tim Hampson. His background in software has spanned technical sales, marketing, and general management in the US, UK, and Japan. Tim started at IBM and went on to a number of successful startups, including Illustra, Interwoven, and BoardVantage. Other experience includes Sybase, Sakkam, and Genesys Telecommunications. Tim, are you ready to take us to the top?
I am indeed, all the way through the bottom.
So there we go. Good. So any of those companies I just mentioned, all those you were a part of, or were you CEO or founder of one of these guys?
So I was very much founder of Sakkam and currently SalesSeek.
Yep.
And at BoardVantage, I was part of the first sort of management team that was brought in with the first institutional funding there. And then the other sort of startups, I was essentially an early employee of those.
Well, then you've seen it. You've been watching and you said, okay, I'm going to jump in and do SalesSeek now. So tell us what the company does and how you make money.
Well, very simple terms, we're a combined CRM and marketing automation tool. So if you think of tools like Salesforce and tools like Eloqua, we kind of like both together. But we sort of optimize for maybe smaller to medium-sized companies, perhaps more so than those tools are. So the way we make money is like many SaaS vendors. It's a SaaS subscription model. So we're fully in the cloud, very easy sort of per user, per month pricing. And we got customers all around the world, including the US and Australia, New Zealand, Europe, and of course the UK as well, where we're based.
And Tim, I don't want to go down every customer cohort, but on average, what's a user pay for a seat for a month?
So we do have a couple of bands. The very lowest level would be about $20, and that would go up to, for the enterprise levels, up to sort of $80 to $100, depending on the sort of the functionality that people were making use of.
This is interesting. I want to call something out here because I'm seeing this pattern with a lot of these interviews I'm doing. There's a lot of people that, a lot of people think, well, when you go enterprise, you're selling larger larger seat deals. So you're selling, 1,000 plans instead of the one-off user that's paying $20 a month. Usually when you're selling, 1,000 seats, there's a discount on the $20 price. But what I'm hearing a lot of people doing or testing is actually they're adding on additional features and they're actually quadrupling the price point even at volume. Is that accurate? Is that what you guys are doing?
Yeah, I think that's accurate. And you're right. It's not just us. It is actually a general theme. And I think the reality is that there's a lot of functionality that only enterprises use. And so, it kind of doesn't make sense to bundle that in for smaller organizations. And indeed, if you were trying to do that and price for it, you would be outcompeted by companies who basically didn't bother with that and just focused on that low end. So I think it's a function of the fact that enterprises do have more sophisticated requirements that, they do have to pay more for it.
Put this on a timeline for us. When did you launch?
We started very, very late in 2012, and we spent the first sort of 2 or 3 years pretty much heads down in product development. And it's really been the last couple of years that we've been sort of in sales mode. So
Tim, talk to me. 3 years in product development, you have to cover salaries somehow. How'd you cover costs? Did you raise immediately?
We self-funded for a lot of that. We got ourselves to be, as I say, sort of ramen profitable. And we also did.
But how did you do that? Sorry, Tim. If you were heads down building for 3 years, there were 3 years there were you had no money, right, coming in.
Right. So we self-funded. So the founders themselves, we basically kicked in our own sort of money and were able to survive on sort of essentially non-existent salaries ourselves. And then after a few years, once we actually got the product launched and started to get the first few customers, we did take our first institutional funding from a UK VC called Sussex Place Ventures.
Okay. And how much total capital have you raised to date?
Total capital has been about just under, I think, 5 million.
Okay. And why not? It sounds like, you guys had some success self-funding for 3 years. Why not just keep self-funding? Why give in and say, okay, we're going to do institutional now after 3 years?
Well, it's a good question to ask because the answer is not always definitively one way for anybody, and certainly not when you look at different organizations. So for us, we took the view that if we have this access to capital, it means we can accelerate scaling out and scaling up in a way that we couldn't do without that. So the good thing about self-funding is that you kind of keep control. you reduce the amount of activity you need to do in fundraising. The disadvantage is that you probably are going to be growing at a slower rate because you just don't have access to the volumes of capital that you might do otherwise. So it's kind of a trade-off. And as I say, I don't think there's a right answer. I think it very much depends on both the company and the founders and what they want to do and everything else.
And walk me through kind of where you've gone over the past, you call it 6 years, right? So how many customers have you scaled to now today?
So we've now got about 150 customers. Our largest customers are over 100 users. And I think one of the biggest differences has been not so much expanding the number of customers, but how we've expanded the size of our customers. So when we started out sort of 3 years ago, most of our customers were sort of, ones and twos. Then that moved to sort of fives to tens. And now we're sort of at the sort of 100 plus user mark there. So for us,
is that an average, Tim? Sorry. So of the 150 logos you have about an average of about 100 seats per team?
No, it'd be less than that now, but that's if you like the historical sort of average. But sort of moving forward, we are looking more like at sort of like 100 users there. And I think the advantage for us as a vendor is that the cost of sale is essentially the same. And in fact, you could argue it's even less, perhaps.
What can you actually quantify that for us? What is the cost of sale today?
It depends on how much you put in there. Obviously, you've got lead acquisition costs, sales costs. But what I would say is that we can basically typically close a deal in maybe somewhere between four to eight sort of calls. And majority of those calls are through the web, which means they're very, very productive. For clients who are locally based, we often sort of see people in person. We like to do that. But, as I said, we've got clients all around the world. And so for those, it is all through remote process. So it's just a question of going through things like Skype, WebEx, etc.
Yeah. Well, let's say you're pursuing, a customer right now that is going to be worth 80 seats for you on day one. And let's assume your minimum at $20 a pop, right? So that's going to be a $1,600 a month kind of customer. Let's just use that customer as an example. How much as a CEO would you be willing to pay for that? 6 months of revenue, 12 months of revenue? What's your upfront CAC on that kind of account?
I would say something like about 9 months of revenue. And, you can look at the lifetime value of a customer as being, maybe something like 3 years on average or something like that.
How do you get to that?
How do you mean, how do you get to that?
How did you calculate lifetime value of 3 years?
Well, it's just on the, it's hard when you're starting out. And of course, after you've been selling for a year, no one's had a lifetime value of more than 1 year. But generally speaking, that seems to be tending to what our lifetime value is. Although having said that, we've been selling for just over 3 years. So, do
you take your churn? Do you do 1 divided by your logo churn rate typically to get that 36 month?
Yeah. The other thing about churn is that, and again, I think this is true of a lot of vendors, is that our churn is very much dependent on user size. And so we even get some sort of singleton users. Their churn rate is very high. So, often if you looked at them, they'd be more like sort of 9 months or 12 months as a sort of typical life value. Whereas larger companies are, predominantly longer than that. So to some degree, we can't necessarily measure the lifetime value of our largest customers because we've not had any churn yet. So,
Talk to me in terms of, when there's customer cohorts that pay vastly different prices. A good way to measure health of a company is, instead of talking about logo churn, is to talk about actual revenue churn. So when you look at your revenue churn over the past 12 months, what has that been?
Oh, that's actually, well, again, for the reasons I outlined just previously, that's been, relatively low. And it's been disguised by growth. So the other dynamic is that you find that you get an 80 user customer. They quite often will increase to 90, 95 users in the course of a year, which means if you have another 10 single users drop off, you still net up.
Yeah. So how that's what I'm asking though is it sounds like you're over 100% net revenue retention annually. How far above 100%?
Not much. I mean, we're about 100%.
Okay, about 100%. So, I mean, so that's pretty good. So, I mean, I imagine it sounds like the pattern you're probably seeing are you have really high churn in kind of these single use cases. However, your expansion, logo going from 50 seats to 100 seats covers 50 lost single seats from other users, right? So that's what's allowing you to keep net revenue retention at about 100%.
Exactly, yeah. And again, for us, strategically, the focus is very much on getting to larger organizations and larger customers, because that's where we see our growth coming. And just the economics of it are just much easier for the vendor to support those.
What do you have to do? Let's say you get a single sign up user and you see the email that signed up is @uber.com. So there's opportunity for enterprise account there, a land and expand approach. What do you have to get that one Uber employee to do in the first week they're using you to drastically increase the likelihood that you're able to expand that?
I think the very first thing is to get data in there. And that, for a CRM, typically revolves around contact data. So we always try and make contact with people who sign up, etc., and make sure they're able to go through that process. And we also put a lot of effort into making that process as simple as possible. Because I think as soon as you've got your own data in the system, you can immediately start to see value because of our integrations with LinkedIn and also in the UK with Companies House. But if you're just relying on a sort of an empty, bare bones skeleton, no matter how good the app looks, if there's no data there, there's nothing to look at.
Yep. Interesting. And tell me more about the team size today. What are you guys at?
Right now, about 20 staff. And we're sales and marketing based very much in the UK. We do have support staff around the world. And we also have, our developers are sort of spread throughout Europe.
Okay. So 20 folks. And just out of curiosity, so how many of those are dedicated to either marketing, onboarding, or retention?
For those categories, we'd have sort of 5 people.
Okay.
Well, 4 people, we'd say.
Okay. Pretty good. And then walk me through, you said you raised capital to drive additional growth. What are you growing at now year over year?
Last 2 years, we've managed to double. This year, we're not quite doubling. But we're hoping to get close to that. So we're still at that sort of early stage where we're able to put in some pretty high growth rates.
Mm-hmm. No, go ahead.
I was going to say, I mean, the main thing for us is that the market, as you can appreciate, CRM is just so huge. There's an awful lot of space for many vendors. As long as you can provide some sort of competitive niche in there, you can carve out for yourself.
Yeah. What's your we're a couple of months away from the end of, I can't believe I'm saying this, but from the end of 2018. What's your big revenue goal for the end of 2018? What run rate would you like to hit as a stretch goal?
As a stretch goal, what we'd like to be doing is to we don't really classify it in terms of revenue, but we'd like to be getting close to break even.
Okay.
And the reason for that is then that just gives us an awful lot more options in terms of taking more capital on or not, as the case may be. But we're a little bit old-fashioned in that we do think that you do fairly soon need to look at profitability.
How far away are you?
I say our stretch goal would be to try and get there by the end of this year. I think more realistically, at some stage during 2019.
I mean, specifically, Tim, today, are you burning like 100K a month or 50K a month or 10K a month? How close are you to that profitability mark?
No, it's a lot. It's in the tens.
Okay. Okay.
And the reason why it's a little bit of a moving target is because let's imagine we did really well and we did get to profitable by the end of this year. We wouldn't want to stop there.
Yep.
We'd actually probably instead want to take more capital and burn more to actually grow more. So it's just one of these things where profitability is good, but at the same time, it's not actually necessarily the be all and end all, because you do need to factor in growth.
Sure. And give me a sense of generally where you're at today in terms of ARR run rate.
That's not something we disclose because we're still in the statistics of small numbers in there. But we're looking to, as I say, we're looking on a profitability basis to make that match up on the numbers. So it's on a monthly basis. We
can back into some minimums just based off numbers you did confirm earlier. So $20 minimum price point. You said 150 logos, and you said less than 100 seats per logo on average. So if we call it 80 seats per 150 logos, that's 12,000 seats at your minimum $20 price point would put you at about $240,000 a month in revenue. Are you guys north of that at this point?
Again, that's not something we want to sort of disclose because that's something we want to keep sort of private.
Sorry, Tim. Just to be clear, I'm just multiplying your minimum numbers. So are one of the numbers you gave me wrong?
No, but those on that mathematics, yeah, that would be correct.
Okay, but what I'm saying is I'm taking your minimums and multiplying. So
Sure.
So is the 150 logos and 80 seats per account at a minimum $20 price point? Are any of those numbers wrong?
No, they're all right.
Okay, great. Well, then, I mean, if that's the case, then brag a little bit. Let me brag for you. You're doing north of 240 grand a month in revenue. You have to be. That's how that's how math works, right, Tim?
That's how math works. If you assume all those, the average is 80. As I said, the average 80 is what we're doing right now.
Okay, so historically it's lower.
Historical average, yeah.
Got it.
But let's say, I mean, I know it's a pain in the arse when vendors are always so circumspect about this.
No, I think it's fair. By the way, there's reasons to share and there's reasons not to share. I think a lot of people, for whatever reason, are self-conscious about what they perceive as smaller numbers. But I think people forget often the most valuable lessons are going from $0 to $1 million in ARR, and everyone has to start at zero. So my job is to get people to talk about it. When do you think? I mean, the lessons you've given us today, are these great for companies going from, call it, 0 to $1 million in ARR? Or are you kind of
yeah, absolutely, yeah. Okay. I think absolutely that's the zone we're in there. And
will you break that though by the end of the year? Do you think? Will you get past $1 million in ARR?
Stretch
goal.
Yeah, always a stretch goal.
All right, very good. I mean, do you think you have to break that before you go do your next round of funding?
I think funding is a function of growth, as it were. So it's more about what's your trajectory looking like. So it's not so much the absolute value as have you actually grown 15% month on month for the past 6 months. If you can show the sort of consistent growth, then that's the trigger for funding more than, because if you're doing, say, 5 million ARR, if that was only growing at a few percent or even declining, that would not be an attractive funding option.
Yeah. I mean, but it sounds like, again, if you're sub $1 million in ARR at this point and you're growing north of 100% year over year, right? So go back 12 months, maybe you're doing 30, 40 grand or something, and you double today to call it, 70 or 80 grand. Most people would say at those numbers, you really want to see more than 200, 300% year over year growth. I mean, how do you guys grow faster?
Well, it's a good question. And that's obviously, a major focus for us right now. For us, we think the main thing we need to do is to get heard. One of the good things about CRM is it's a huge marketplace. One of the bad things about it is that, of course, it is so huge, it's hard to make yourself heard.
Not just huge, Tim, too. HubSpot's basically commoditizing it with their free CRM. I mean, how do you compete with a free product?
Well, when you talk to HubSpot users, you find out that it's not entirely free. I think from our point of view, we do see HubSpot as a significant competitor for us, but not because it's free, because like ourselves, it's actually a very good integrated suite of marketing automation and CRM. So I think the way to look at HubSpot is not free CRM, but rather an integrated CRM and marketing automation tool that costs X.
Yep. Very good. Let's wrap up, Tim, with the famous 5 quick answers here. Number 1, what's your favorite business book?
Crossing the Chasm, Jeffrey Moore.
Number 2, is there a CEO you're following or studying?
No, actually.
Number 3, what is your favorite online tool for building a business besides your own?
Xero, the accounting package.
Number 4, how many hours of sleep do you get every night?
At least 8.
And
it varies. Let's say between 6 and 8. Yeah.
Fair enough. And Tim, what's your situation? Married, single, kiddos?
Married with 1 kid.
1 kid. And how old are you?
He's just coming up to 11.
Sorry, you.
Oh, me? I'm 54.
54. So say you look great for. I mean, all right. Take us home, Tim. Last question. What do you wish your 20-year-old self knew?
That is a good question. I think, it's hard to net that down to just sort of one thing. I guess it would be. It's not about. What I would say is it's not really about your network in the sense of who you know. I think it's more about your ability to network. So what I've often found is as I move from different areas into also in different companies, is that it's not so much about existing or previous contacts being useful. It's been more about being the ability to generate new contacts in this new context that was valuable.
Guys, there you have it. Networking and context really critical. From Tim, founded SalesSeek back in 2012 after a lot of experience at very successful companies. Today, they have about 20 people based between the UK and other remote locations. They've got about 150 logos paying them, really striving hard to break that $1 million in ARR mark, reach profitability, and then get to the point where they can choose whatever they want to do in terms of their destiny, raise capital, keep growing profitably, etc. They've got over 100% net revenue retention annually to date. He's willing to spend up to 9 months of user kind of revenue on acquiring that same customer. Landing seat size is now in the 80 to 100 kind of team size range as they look to scale. Tim, thank you so much for taking us to the top.
Thank you, Nathan.